International financial expansion is historically a process of high friction. Entering a new market subjects your capital to the grinding pressure of foreign tax codes and regulatory bottlenecks. While global finance moves at the speed of a digital pulse, establishing operations in legacy hubs like London or Singapore requires navigating centuries of rigid, entrenched infrastructure. Firms expanding into these traditional centers face three primary hurdles: corporate tax rates that erode margins, multi-agency bureaucracy that delays operations, and heavy duties on real estate. Geographically, Turkey sits between the European and Asian capital markets, acting as a physical bridge. To capture the flow of that capital, the state has moved to remove the administrative friction associated with the region. This is the Istanbul Finance Center, or the IFC. Located on the Asian side, this zone operates as a legally distinct financial ecosystem. Rather than attempting to retrofit modern financial incentives into the existing laws of a sprawling city, Turkey constructed a custom regulatory zone. The rules inside this perimeter are decoupled from the standard Turkish tax code. To function, the ecosystem limits participation to specific entities. It gathers public and private sector banks, asset management companies, brokerage firms, and capital market institutions into one concentrated network. The economic engine driving this entire zone relies on a specific legal mechanism: financial service exportation. Financial service exportation means an IFC company provides services to clients abroad. The service originates in Istanbul, but is utilized externally. Firms then deduct 100% of these profits from their corporate tax. This deduction is guaranteed through 2031, settling later at 75%. By isolating the tax burden on foreign client services, this structure rewards institutions for building borderless business models based out of Istanbul. A zero-tax structure on foreign services only works if the zone can attract the human capital required to run those services. To draw in specialized expats, the IFC uses graduated income tax exemptions. Professionals with 5 years of overseas experience receive a 60% salary exemption from income tax. For those with 10 years of experience, that exemption increases to 80%. The physical costs of housing these firms are also reduced. Companies renting office space within the boundaries of the IFC are exempt from standard rental fees and stamp duties. Beyond taxation, the zone addresses the administrative delay of global expansion. It utilizes a system called the Tek Durak Bureau, or the One-Stop Office. The IFM portal condenses 6 different national ministries and local municipalities into a single digital application. This replaces separate registrations with the Ministry of Treasury, Commerce, and Labor departments with a single document, the Participant Certificate. Bypassing these layers of multi-agency approval consolidates legal establishment, tax processing, and work permits into a single point of contact. For a multinational firm, reducing the time to market is a direct driver of profitability. The ecosystem combines several high-impact incentives: 100% corporate tax deductions, significant expat salary exemptions, and a consolidated bureaucratic process. These internal mechanisms allow Turkey to leverage its position between Europe and Asia, offering a path for capital that bypasses the traditional friction of the region. Capital gravitates toward the path of least resistance. By removing these barriers, Turkey is positioning to capture asset flows between European and Asian markets. The legal framework is now fully operational. For global financial institutions, the opportunity to secure a participant certificate and access these margins is immediate and time-sensitive.